Something very important just happened in Iraq, and most people around the world barely noticed it. Iraq has begun introducing a government-controlled digital version of its national currency, often referred to as the digital dinar. And while on the surface that might sound like just another financial technology upgrade, the deeper implications are much bigger than most headlines are suggesting. For years, the conversation around central bank digital currencies has mostly focused on large economies experimenting with digital money systems, like when the government of China began developing its digital yuan, or when the island nation of the Bahamas introduced the sand dollar as one of the first fully launched national digital currencies. Those examples happened in relatively stable financial environments, with mature banking systems and strong digital infrastructure. Iraq's situation is very different, and that is exactly why the timing of this development has started raising serious questions among economists, geopolitical analysts, and currency observers. Iraq spent the past 2 decades rebuilding after war, political instability, corruption challenges, and an economy heavily dependent on oil exports. Yet, despite those obstacles, the country still holds some of the largest proven oil reserves on the planet and continues producing millions of barrels per day. At the same time, the country has quietly accumulated significant foreign currency reserves held by the central bank, giving it a financial cushion that many developing economies simply do not have. When you combine those reserves with natural resource wealth, slowly improving infrastructure, and an economy that is gradually stabilizing after years of disruption, you begin to see why some policymakers might be thinking about long-term structural changes to the monetary system. A central bank digital currency changes how money moves through an economy. Instead of relying entirely on physical banknotes and traditional bank transfers, a digital currency allows transactions to move through a centralized digital infrastructure that is monitored directly by the central bank. That means the government can see where money flows, how quickly it moves, where capital leaves the system, and how economic activity behaves in real time. For countries that struggle with large cash economies and limited banking access, this type of transparency can dramatically increase the effectiveness of monetary policy. Iraq has long faced challenges with financial inclusion because large parts of the population operate outside the formal banking system, relying mostly on cash transactions. When a significant percentage of economic activity exists outside official channels, governments lose visibility into how money circulates, which makes managing inflation, taxation, and currency stability far more difficult. Digital wallets connected to a central bank system can potentially bring millions of people into the formal financial network simply through mobile phones, allowing individuals and businesses to transact electronically without needing traditional bank accounts. That expansion of the formal economy increases recorded economic activity, improves tax collection, and strengthens the central bank's ability to manage liquidity. But the technological infrastructure itself is only one part of the story. The bigger conversation that quietly follows any major currency modernization effort is the question of long-term currency valuation. Iraq's dinar has traded at a relatively weak exchange rate for many years due to political uncertainty, war damage, inflation pressures, and structural economic problems. However, currencies do not stay fixed forever, and governments sometimes adjust the official value of their currency when economic conditions change. A currency revaluation happens when a government formally increases the value of its currency relative to foreign currencies, which is different from normal exchange rate fluctuations driven by market trading. Instead of the currency gradually moving due to supply and demand in foreign exchange markets, a revaluation is a policy decision in which the central bank sets a new official rate and restructures the monetary system around it. These kinds of adjustments are rare because they carry major economic consequences. When a currency becomes stronger, imports become cheaper because the country can buy more foreign goods with fewer units of its own currency. That sounds beneficial for consumers because imported products cost less, but it also means domestic industries suddenly face stronger competition from foreign producers. For export-driven economies, the situation can become even more complicated because their goods become more expensive for international buyers, which can reduce export competitiveness. Iraq's economy revolves heavily around oil exports, which means global oil prices still play the dominant role in determining revenue, but changes in the currency system could still affect many other sectors of the economy. One of the reasons digital currencies matter in this context is that they give central banks more precise control over financial flows during major economic transitions. With a digital currency infrastructure, the central bank can monitor liquidity levels across the banking system in real time, adjust monetary policy faster, and implement targeted financial measures when certain sectors experience pressure. Instead of relying on delayed reports and partial economic data, policymakers gain immediate visibility into how economic actors are responding to policy changes. That kind of real-time oversight becomes extremely valuable if a country ever decides to adjust its currency policy in a significant way. Beyond domestic economics, there is also a geopolitical dimension to consider. Over the past decade, global financial systems have slowly begun evolving as countries explore alternatives to traditional dollar-dominated payment networks. For decades, most international oil transactions have been settled in US dollars, forming what analysts often call the petrodollar system. While that system still dominates global energy trade, several countries have started experimenting with new settlement mechanisms, including bilateral currency agreements and digital payment infrastructures that allow cross-border trade using national currencies instead of relying entirely on dollar clearing networks. A digital currency potentially gives a country more flexibility when negotiating trade relationships, because digital payment systems can be integrated into international settlement networks without relying exclusively on traditional banking intermediaries. That does not mean the global reserve currency system suddenly changes overnight, but it does mean that countries gain additional tools for conducting trade in ways that were not possible in the past. Iraq sits at a strategic crossroads between the Middle East, Asia, and Europe, which means its economic policy decisions often intersect with broader geopolitical trends. The country maintains relationships with Western financial institutions while also expanding economic ties with regional neighbors and emerging global powers. In that context, building modern digital financial infrastructure could be viewed as part of a long-term strategy to position the country for a more interconnected global economy. For investors and market observers, the most important thing is not speculation but signals. The real indicators of whether a digital currency initiative succeeds include adoption rates among citizens and businesses, stability in foreign currency reserves, continued improvements in financial infrastructure, and consistent economic policy from the government. If businesses begin accepting digital payments widely and citizens adopt digital wallets for everyday transactions, the system gains credibility. If the central bank maintains strong reserves and stable monetary policy, confidence in the currency gradually strengthens. If political instability increases or financial institutions struggle to integrate the technology, progress can slow dramatically. Currency systems ultimately depend on trust. People must believe that the money they hold will maintain its value and remain widely accepted for goods and services. Building that trust takes time, particularly in countries that have experienced economic instability in the past. But when governments invest in modern financial infrastructure, strengthen reserve positions, and integrate more citizens into the formal economy, they create the foundation for a stronger monetary system over the long term. Iraq's digital Dinar initiative, therefore, represents more than a technological experiment. It represents an attempt to modernize financial architecture in a country that has spent years rebuilding its institutions and economic capacity. Whether the digital currency ultimately becomes a transformative tool or simply another incremental reform will depend on how effectively it is implemented and how the broader economy evolves over the coming years. What is clear is that the global financial landscape is changing. Governments around the world are exploring digital versions of national currencies. Central banks are experimenting with new settlement systems, and digital payment infrastructure is becoming an increasingly important component of economic policy. Iraq's decision to move in this direction places it among a growing group of countries attempting to reshape how money functions in the digital age. The long-term results remain uncertain, But the move itself signals that policymakers are thinking about the future of their financial system and how it fits into a rapidly changing global economy where technology, geopolitics, and monetary policy are becoming more interconnected than ever before.